If you're a beginner, you've probably memorized hammer, doji, engulfing, morning star. But here's the uncomfortable truth. Most traders lose money using candlestick patterns. Not because the patterns don't work, but because they don't understand what they're actually seeing. Today, I'm going to explain candlestick patterns in a way that actually makes sense. No memorizing shapes. No random guessing. By the end of this video, you'll understand what candles really represent and when they actually matter. Let's get into it. Exhaustion 1. What a candlestick really means. Before patterns, you need to understand one candle. A candlestick shows four things: open, high, low, or close. But that's not the important part. What matters is this. A candle shows a battle between buyers and sellers. Let me explain simply. If a candle closes bullish green, that means buyers won that time period. If it closes bearish red, sellers won. But here's the key. The wick show rejection. The BD shows control. Long body equals sign strong control. Long wick equals sign rejection or failed push. Stop thinking of candles as shapes. Start thinking of them as pressure. When you understand that, patterns become logical. Exhaustion 2. The hammer and why beginners misuse it. Let's talk about the hammer. What beginners memorize: small body, long lower wick. Bullish reversal. But that's surface level thinking. What does a hammer actually mean? It means sellers pushed price down aggressively, but buyers stepped in and forced it back up before the candle closed. That's rejection of lower prices. Now here's the mistake beginners make. They see a hammer anywhere and buy. Wrong. A hammer in the middle of nowhere means nothing. A hammer after a strong downtrend. Near support. Inside a liquidity zone. Now it matters. Context creates power. Pattern alone is weak. Exhaustion 3. Engulfing patterns, real momentum shift. Bullish engulfing pattern. What is it really? It's when buyers completely overpower the previous candle. The second candle's body fully engulfs the first. This is a momentum shift. But here's what most people ignore. Size matters. If the engulfing candle is tiny, that's not strong conviction. If it's large, aggressive, and closes near the high, that shows dominance. Also, engulfing patterns work best after pullbacks, at key levels, during trend continuation. Random engulfing in chop equals sign trap. Remember, candles reflect aggression. You're trading aggression. Exhaustion 4. The doji indecision, not magic. A doji simply means open and close are almost equal. Neither buyers nor sellers won. It's balance. But beginners treat dojis like automatic reversals. They're not. A doji at the top of a strong uptrend could mean buyers are getting tired. Sellers are stepping in. Pause before continuation. You need confirmation. Next candle matters more than the doji itself. Think of a doji as a question mark, not an answer. Exhaustion 5. Morning star and evening star exhaustion pattern. Morning star, strong bearish candle. Small indecision candle. Strong bullish candle. What's happening? First, sellers dominate. Second, selling slows. Third, buyers take control. That's transition. Evening star is the opposite. But here's the key. These patterns are stronger on higher time frames. On the 1-minute chart, they appear constantly. On the 4H or daily, they carry more weight. Time frame increases reliability. Noise decreases clarity. For more videos, subscribe to the channel. Exhaustion 6. Why most people still lose using patterns. Now let's address the real issue. Why do beginners lose even when they know patterns? Because they ignore trend direction, market structure, liquidity, volume, risk management, Candlestick patterns are not entry signals. They are confirmation tools. Let me say that again. They confirm bias. They don't create bias. If the trend is bullish, you look for bullish confirmation patterns. If the trend is bearish, you look for bearish confirmation patterns. Trading against trend because of one candle, that's gambling. Exhaustion 7. The right way to use candlestick patterns. Here's a simple framework you can follow as a beginner. Step 1. Identify trend higher highs plus higher lows equal sign bullish, lower highs plus lower lows equal sign bearish. Step 2. Mark key levels, support, resistance, liquidity zones. Step 3. Wait for price to reach that area. Step 4. Look for confirmation pattern. Hammer at support in uptrend equal sign valid, bullish engulfing after pullback equal sign valid. Random pattern mid-chart equal sign ignore. You don't need 15 patterns. You need 3, 4 that you deeply understand. Master simplicity. Exhaustion 8. Risk management, the part nobody wants to hear. Even perfect pattern reading will not give you 100% win rate. Losses are part of trading. So, always use stop loss, risk small percentage per trade, except drawdowns. If you risk too much, even good setups will destroy your account. Patterns improve probability. They don't eliminate risk. Exhaustion 9. Beginner mistakes to avoid. Let me save you months of frustration. Avoid this. Taking every hammer you see. Trading patterns on 1-minute charts. Ignoring trend direction. Overloading charts with indicators. Entering before candle closes. Wait for confirmation. Patience beats speed. Recap. Candlestick patterns are powerful, but only when you understand. They show pressure. They show rejection. They show momentum shift. They do not guarantee reversals. Trading is about stacking probabilities, not predicting the future. Final message. If you're serious about learning trading, stop memorizing shapes. Start understanding behavior. When you look at a candle, ask, who's in control? Who just got trapped? Who is losing strength? That mindset will separate you from 90% of beginners. If this helped you finally understand candlestick patterns properly, subscribe to the channel. I'll be breaking down market structure, liquidity concepts, risk management frameworks, beginner trading roadmaps. I'll see you in the next one.